We start accounting already. So in chapter 1, types of business organization. So when we talk about business organization, we're talking about businesses, but with their structure, because they have different structure, because they have different legal structure. That's why we have to call them separate names. We have the sole trader, we have the partnership, we have the private sector organizations, the public sector organization, and so on. So because of their legal status or legal structure, that's why we have to name them based on what they have. So we're going to start today with sole trader. Thank you. So for sole trader, who is a sole trader? Here it says sole trader is sole tradership is the easiest form of business organization to set up. A sole trader is an individual trading alone under his or her own name or under a trading name. The sole trader is fully responsible for the running of a business. He or she is the only financial beneficiary of its success, or he or she is also financially responsible if the business fails. So a sole trader is that individual who owns its own business. So that means whatever he or she does, basically it's for him or her. So both the benefits are around it and the failure or the liability around it, he or she bears the risk.
Yes.
Do you understand? So that's why we call it a sole trader. So here's a sole trader. Okay. So when we talk about the financial beneficiary, we're talking about all the gains that the sole trader will make, all the gains he or she is going to make belongs to him or her. And whatever happens, if the business fails, he or she bears all the burden.
Yes.
I think it's clear.
Yeah.
So we go to the second paragraph. A sole trader, read please.
Which one?
A sole trader
has unlimited liability. This means that in the eyes of the law, the owner and the business are the same. If the business is unable to meet its financial obligations and cannot pay its bills, a court has the authority to hand over the sole trader's personal assets to cover these debts. The sole trader may have to sell his or her home or car. For example, if the sole trader cannot cover all outstanding debts, the sole trader may be forced to declare
him or herself bankrupt.
Bankrupt.
So what you're saying is this: for a sole trader has unlimited liability. And when we talk about unlimited liability, it means that the debt of the business, the debt the business is having.
What's that?
What you owe to other people. Yeah, what you owe to third party. What you owe to them. So it's a debt. So whatever you owe to third party and the business is unable to pay it, has to be transferred through your personal wealth. So that means whatever debt that is available for the business can be retrieved from your personal wealth. I think it's clear. Yeah. So when the sole trader is being declared, a sole trader has to declare him or herself bankrupt. It means he or she doesn't have the assets to pay off its debts or the liability. That means the liabilities are more than the available assets. Yes. So that means it doesn't have what it takes that will make it liquidate to pay off the debts. Do you understand?
Yes.
So that's about that. Then we go on to, let's just go to the advantages immediately. So for the advantages of a sole trader, they said business is easy to set up. Yeah, as a sole trader, you can set up the business within even your house here. As a sole trader, you can have a shop around here. You can have a small office around here.
Yeah.
So you don't need a big premises. You don't need significant or huge store to start up with. So it's easy. And you don't need any formality. You don't need any paperwork. 2, sole trader keeps all profits. So the second advantage about sole trader is that we said a sole trader is a financial beneficiary to its business. So that means whatever benefits, whatever profit a sole trader makes, all belongs to him or her.
Yes.
That's another advantage. The third one, a sole trader has complete control. So a sole trader takes decision regarding the business, regarding the operations of the business. So he's the sole person that can take decisions. So he has that independence to take whatever decisions he or she feels he has to take, he or she has to take.
Yes.
The fourth one, easier to make decisions. So now that we talked about complete control, which means you have the ability to take decisions. The fourth one is talking about easier to make decisions. So you don't need to consult people.
Yes.
You don't have to consult people before you take your decision. You could take it at any point in time. You get it? And you don't have to wait for people to say yes or no to it.
Yes.
It's your business. Accounts do not have to be published. So here, in other form of businesses like the private limited company or the public limited company, you have to publish your accounts, especially the public limited companies. What publication means is that your financial transactions, your financial dealings, you have to let it known to the public or especially to the government.
Yes.
So that's an advantage you have as a sole trader. You don't have to publish your accounting, your financial statement. Is it clear?
Yes.
So what are the problems you could face as a sole trader? Number one, sole trader may lack capital or equity and find it difficult to raise money. So what we're talking about is this.
Where's more?
Well, to raise more, yeah. More is money, to raise more money. So what we're trying to say in essence is this. As a sole trader, because it's typically a small business, it might be difficult for you you can't sell shares, which could help you to raise cash or capital.
What's shares?
Shares these are selling part of the investment of a company to the public.
Oh, yeah.
So they become shareholders of your company. They invested. So as a sole trader, you can't, because your company is an unlimited liability. Yeah. Do you understand? So it's not a limited liability company, so you can't sell shares. And more of talking about capital equity, the only amount of money you have that you can use in running the business is the amount of money you have with you. So because it's only you, so the business is as big as your pocket. Yeah. Do you understand? Yes. The business is as big as your cash in hand or your cash at bank. Do you get the point? The second one, sole trader is personally liable for all debts. So what we're talking about here is this. Whatever debt the business is owing, it belongs to the sole trader. So you owe people, your business can't pay, your car might be sold to pay off, your house might be sold to pay off. The third one, sole trader may lack appropriate skills. Yeah, it could happen. Yeah, as a sole trader, because whatever you have, your knowledge, your skills are limited. You are not adding other people's skills. So whatever you can do, whatever your business is going to become, it's solely on your own ability.
Yes, your skills.
Do you understand? So you might lack skills in certain areas, which might affect the business.
Yeah.
Do you get the point there? Is it clear, please?
Yes.
Okay. The fourth one, making all decisions can be stressful. You have to take all decisions. You take financial decisions, you take logistic decisions, you take managerial decisions, you take whatever decision that has to come in the operations, and that might wear you out.
Of course.
And you have to work long hours because it's only you. No continuity as businesses ceases when sole trader dies. The end of the owner of the business means the end of the business. Is it clear?
Yes, it is.
So that's all about sole trader.
Is this a disadvantage?
Yeah, when the owner of the business dies, the business is over. There's no continuity. And remember, in accounting, there's what we call a going concern concept.
Why is it a disadvantage?
It's a disadvantage because your business, the business that you've put so much effort to put together, because you are dead, the business is over.
You'll be dead.
Yeah, but what about the efforts?
That won't affect you.
No, yeah, it won't affect you, but it affects the effort you put into it. Like, it's supposed to be continued.
Maybe your sister or your...
Yeah, should take over, but they won't be able to. That's the disadvantage now. Is it clear?
Yeah.
So it's a disadvantage because the business should be a going concern. Business should be run as if they will never end. That's how business should be run. Do you understand? So if the business stopped in the middle or stopped without being prepared for, then it's a disadvantage. Yes. So that was another problem of a sole trader. Do you have any question about it now? So we'll move on. So now we have
partnership.
Yeah, before we go to the partnership, they said, how do you think an accountant can help a sole trader run their business. So here, look at what you could talk about is, we know who an accountant is. An accountant is that individual who keeps records, financial records. So it could help a sole trader because a sole trader might lack the skills to set up its own accounting book. So the accountant might do that. Yeah, it's book of entry, all its transactions.
Yes.
You know, transactions will continue to go on, off and on. The sole trader might not have that ability to put up a ledger or a financial statement or like a profit and loss account or a balance sheet. So the accountant could help in that aspect. So the accountant will act as a consultant to help the sole trader. I think it's clear. Is it clear, please?
Yes.
Now for the second one, it's okay. Let's forget about that. So go to partnership. So the second form of business is partnership. That means you are moving from one-man business to 2 or 20. So here, please read for me.
The main difference between a partnership and a sole trader is the number of owners. A partnership is defined as having between 2 and 20 owners. These owners have unlimited liabilities. A contract is usually drawn up to show how profits and losses are shared. This contract is called the deed of partnership. An accountant or solicitor normally draws up this deed of partnership to avoid potential problems. It must obey the law of the country the business is in. For example, the Partnership Act 1890 in the UK and the Partnership Act of 1932 in Bangladesh.
So what we're talking about partnership is that it's a business, it's a form of business, and what makes it different from a sole trader is that it involves 2 to 20 owners.
Does it have to only be 20?
I think the maximum, yes, 20.
Okay.
The maximum is 20. According to the law, the maximum is 20. So that makes it different from a sole trader. So the partnership, there's always a partnership agreement, which we call a contractual agreement between those partners, because it's difficult when you have 2 to 20 people running a business. So there's always a need to have something that governs your activities, something that governs your operations. What guides your operations? It's not going to be like we just run it as it comes. No, we need a document that will guide what we do, because it's not just me alone, it's not just you alone, it's not a sole trader that you are a sole decision taker. But here, every individual has the right to take decisions. As a result of that, it is important to have an agreement on the basis of how decisions will be taken, on the basis of how profit will be shared, on the basis of how losses will be shared, on the basis of how salary will be paid, on the basis of how interest will be paid. So what sums up all this? Okay, so what sums up all this is through the partnership deed. So the partnership deed is a contractual agreement or a document.
Contract.
Yeah, it's a contract. It's a document binding all the activities of the partners. Okay, so let's go straight to the advantages of partnerships. Now, advantages. The first one. Yeah, please.
More capital or equity can be raised through additional partners.
So the first advantage of having a partnership or having a partner is that a partner will come with additional capital. So as a sole trader, I told you, like as a sole trader, the financial capability is what you have. So what you have in your pocket, what you have in cash, what you have in bank is all you can use in operating the business. But when you invite a partner to come join your business, it means the partner is coming with capital. The partner is coming with money. So that means you can raise additional capital having a new partner. Is it not an advantage? Because you have more capital to run the business.
Yeah.
2,
losses can be shared between partners.
So as a sole trader, all your losses are your own burden. Nobody shares it with you. But when you have a partner, it means whenever the business is going at a loss, it will be shared among partners.
Yes.
Is it clear? The third one.
Additional partners may bring more skills and
Expertise
to the business.
So remember, in the sole trader business, as a sole trader, your skills are limited. It is only what you have you can give out.
Yeah.
But when you are inviting a new partner, the new partner might be coming with a different skill, that is a different skills from yours. So that means you can add up different skills. You can add up the skills together.
Yeah.
So your skills becomes limitless.
Yes.
Is it clear? Or unlimited. Then the third one.
The responsibility of management can be shared between the partners.
Yeah. As a sole trader, you take decisions. And when you have to take decisions about everything, you become stressed or worn out. But right now, because you have a partner, it means you can share ideas. You can take decisions together.
Partnerships are ideal organizations for professional practices such as medicine, law, and accounting.
These professions, they don't need huge office setup or company. As you can be consultant. You can have a small office as an accountant. You can have, when you go to the lawyers, when you go to their chamber, it's always small. Yes or no? Yeah, because they don't need so much big like a thing like that. So 2 or 3 people can be in the same office and they are partners.
Yes.
That kind of professions doesn't need you to have a very big company.
Yes.
So partnership is ideal for such business. And you might be an accountant, I might be a lawyer, you might be a dentist. We can still use the same.
Yes.
Okay.
Yes. Profits from a partnership are taxed as the personal
income of the partnership. So the advantage here is that the taxes paid will be based on the partnership business. It is income tax, which means taxes are less. It's not going to be, when it is whatever profit you make, you're not going to be charged, you're not going to be taxed on profit. You'll be taxed on the income. So it means that it's just going to be like taxing an individual. I'm being taxed on what I make. That is the same as what the partnership is. The partnership is a business, right? But it will be taxed as an individual.
How?
It will be paying income tax, not corporation tax.
Nice.
Yeah, there's corporation tax, which is taxes on profits. But as a partnership, in partnership, you don't pay corporation tax. You pay income tax. They charge your company like they are charging an individual.
Yes.
Is it clear now?
Yes.
So it's just like what I have to pay because of what I make for my salary. So they will be taxing. The tax a partnership will pay will be the tax partnership business will pay the same as the tax an individual will pay. It's not like we are paying profit tax, yes, which is huge.
Yeah.
The last advantage there.
Financial information is not published.
Same as the sole trader. So the partnership does not need to publish or make publications of their financial statements. So nobody needs to know.
How?
The dealings of the partnership, the dealings or the operations of the business, in terms of what they make in profit.
But they have a company, like they have a place.
Yeah, they have, but they don't need to publish their financial information, what they make, the profits they make, the assets they have.
Would they?
They won't. That becomes an advantage.
Who does?
Other businesses will do, like a private limited company, a public limited company will do, according to the law.
Why? But who would they tell?
Government.
Oh,
did you get it now? So because it's a partnership business, it has this advantage of not publicizing or of not publishing its financial statements, which means
even sole traders.
Yeah. So that means other sole trader businesses or other competitors would not know your work as a business, would not know what you do. Do you understand? That's why it is an advantage.
What you gain?
They don't know.
Yes.
Nobody knows. Is it clear?
Yeah.
So what are the problems you might encounter when you have a partnership, when you have partners? The first one.
The partners have unlimited liabilities. This means they will have to cover the debts of each part. The debts.
The debts.
It's V.
Yeah, it's not pronounced. The debts of the business.
The debts of each partners.
Yeah.
For example, if one of the partners steals money from the business, the other partners will make to cover.
Will have to cover these debts.
So may have to.
And may have to sell their personal assets to do so. Note. Yeah. Note, I'll explain. Note, this excludes limited partners. So what they are saying is this.
What's C below?
What?
They said C below.
Yeah, it's there. We'll see it when we get there. When you go down, you see the more. You get further information when you scroll down.
Okay.
So what they're saying here is this: if one of the partner, any mistake of the partner is bounded to all. So your mistake is our mistake. That's the problem about partners. So if one partner steals, the other partners have to pay for it. If one partner fails, the other partners also failed.
Yes.
Do you understand? So it is bound by law that whatever happens with one partner happens to all the partners. Is it clear? The second one.
A partnership.
Except the limited partner. Why do we call them limited partner? We call them limited partner because they have capital in that business, but they don't partake in decision making of the business. They are dormant. They are dormant partner or sleeping partner. So all they do is to put money into the business, and the only thing they could lose is the money they put into the business. They won't lose their personal wealth like other unlimited partners.
Yes.
Other partners are unlimited except a limited partner. A limited partner is that partner who only has capital in the business. He's not physically appearing in the business. He's not partaking, or he doesn't partake in the activities and decision making of the business.
Yes.
Is it clear? We call those people limited partners or dormant sleeping partners.
A partnership is dissolved on the death of a partner.
So it's a partnership. As soon as one partner dies, the partnership deal is off.
With him?
No, they have to dissolve the partnership immediately.
For everyone?
Yeah, because they have to share everything. Do you understand? Because partnership is not transferable. I can't transfer my dealings here to my son or to my daughter or to my brother or my sister. No, it has to be dissolved.
Yeah. The
third one.
It is difficult to liquidate or transfer a partnership.
Yeah, I just said that now.
Yes.
So it's difficult to liquidate. That means it's difficult to change money or get anything from partnership. Yes, yes.
A partnership may still find it difficult to raise capital or equity for expansion, as increased unlimited liabilities could act as a deterrent.
So, irrespective of how much you could make as a partnership business, it is still limited because you cannot have more than 20 partners. So that means the only amount of money that can be available, the only capital that can be available to you in partnership is the capital of 20 people. Aside that, no more.
Yeah, but that's pretty much.
Yeah, you wouldn't know. You wouldn't know how big the business might be if there are more than 20 people, but you would not have that opportunity. And another problem is that because they are unlimited liability, it means that even as partners, you are conscious of what you do, because you know that if the business fails, it could be transferred. Your wealth can go for it. So you are conscious about that. Do you understand? Okay.
Profits have to be shared between the partners.
As losses being shared, which means you get little portion of loss, which means it's good for you. Same goes to the profit. Your return will be less because all partners have to share the profit.
Yes.
Do you understand? So that means the return on each partner's investment will be less. That is why it is a disadvantage. Do you understand? The next one.
There could be conflict between the partners.
Yeah, you're talking about 2 to 20 people coming together. They have to take decisions. They have to make decisions. Some decisions will not be favorable. while other decisions will be favorable. So in the case of not unfavorable condition or unfavorable decision, we might disagree. There might be conflict. And this might halt the partnership business.
Yes, of course.
Is it clear?
Yes.
Okay. Let's forget about give examples. So here they said, so limited partners, that's what they said, see below. But I already explained what a limited partner is to you. Look at what they said. They said in a limited partnership, there must be at least one partner who is not limited. Limited partners are not liable to the debts of the business. They can only lose the capital equity they have invested in the business. All limited partners must be registered with the registrar of companies. So like I told you earlier, for limited partners, they don't lose their personal wealth in case of debt to the business. They don't lose their personal wealth, but they might lose their investment. But for unlimited partners, they lose both investment and even their personal wealth into the debt of the business. Do you understand? Then we go to deed of partners. For deed of partners, they wrote, a deed of partnership is a contract between partners that can be either written or verbal. A deed of partnership has no specific requirements by law, so it cannot contain as much as or as little as the partners wish. In fact, by law, you do not need a deed of partnership, but it can help to solve any argument later. It normally includes, so when we talk about a deed of partner, it's because we're talking about 2 to 20 people coming together to form a business with the aim of making profit. It is difficult when you don't have some rules that guide what you do, when you don't have some agreements on hand when you are starting it up.
Yes.
So it's because you're talking about humans who are dynamic in nature. So it means that we need something that will guide whatever we do. We need to be guided.
Yeah.
So for the partners, for the partnership, they use the partnership deed as a guide for what they do. So they are guided with the partnership deed. So what are those things that could contain, that entails, or that you can find in the partnership deed? The first one, the capital or equity contributed by each partner. That means the amount of money each partner puts into the business. 2, the ratio at which profits and losses are to be shared. So profit will be made, losses could be made. So how do we share profit? How do we share losses? It has to be stated or written in the deed. The third one, salaries to be paid to partners. Some partners are active partners. So they have investment in the business, and at the same time, they work for the business. Do you understand? They have investment in the business. At the same time, they still work as employees in the business. So they are entitled to salary. So the amount of salary they have to get has to be stated there too. Is it clear? Is it clear, please?
Yes.
The third one, salaries to be paid to partners. So the amount of salaries that have to be, okay, we talked about that already. The fourth one, interest, if any, to be paid on capital or equity. Sometimes the business might need more capital, and one partner might be willing to give that money into the business. But if he's doing that, he or she will have interest. He will get interest from the capital he's giving to the business. Interest means that he has to pay him certain percentage because he's making funds available for the business, and the business is separate from them. Though in partnership, the business is not separated. But if a partner is giving certain amount of money to the business that is not part of the agreement beforehand, then he might request for interest. Do you understand? That is interest on capital or equity. And at the same time, a partner might feel like taking money from the business. So if a partner is taking money from the business and other partners accept it, he might be told to pay interest on it.
No.
Interest, like you are giving money to the business is going to pay you interest. As same as when you take money from the business, you might be charged interest on your drawings.
Yes.
Do you get it?
Yes.
So the different capital is the amount of money the owner of the business is giving to the business. Drawing is the amount of money the owner of the business is taking from the business. So in the partnership deed, you might be given interest. It might be stated in the deed that whenever a partner gives money to the business, will give him or her 5% interest. Whenever a partner is taking money from the business, a partner might need money and he doesn't have any other place to get the money from except from the business. Whenever a partner is taking money from the business, which is joint, might be charged 3% of interest or 7% of interest. So all these will be written in the partnership deed.
Yeah.
So as there won't be disagreement or conflict. And
okay. If it hasn't been written.
No, it has to be. It has to be. And the last thing that I didn't mention here is that they didn't mention is dissolution of partners. How the partnership can be dissolved. It will be stated in the partnership deed. And also how they accept new partners. Do you understand? So this is what the partnership deed entails. So we'll go down to the case study now. Please look at the case study. Read it.
I read it.
The case study. So can you answer it now?
Yes.
Okay. It said, why do you think Annie wants to expand his business?
Because he wants. I don't know how to answer this question, because he wants to expand his business because he wants more.
More what?
More profit.
More profit. Yeah, you said that.
Yes.
Okay. So, what are the advantages of Annie and Nzuzi of going into partnership together? We're talking about the advantages of partnership.
Profit will be more capital.
Yeah, that's an advantage. They have more working capital.
Yes, they have more capital. More skills.
Yeah, more skills will be added. Thank you. Okay.
What else?
They share the burden. They share the losses together.
That's not.
It's an advantage.
Yes.
Because before now, it was only Aniza, right? Hanif. It was only Hanif. So that means Hanif then had to take all these losses. But now there's Nzuzi. So they have to share the losses, which is an advantage. So what are the problems they would face being partners? Disagreements. They could disagree on things. Yeah, they could disagree on things. One. They're going to share profits, which means their returns will be less.
That's not a disadvantage.
It's a problem.
Why?
Before now, you have all the profits to you. But now
you have more capital.
Yeah, but so, whatever it is, whatever the case might be, profit for one, profit that you're supposed to take all, now you have to share it. It means that your profit is less. That is the problem.
Yeah.
Okay. What helps? Unlimited liability. The debts of the business can be transferred to their personal wealth. The debts of the business can be transferred to their personal wealth.
Yes, yes.
Is it clear?